Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I want to it's nothing to do with the thesis, but I'm going to go towards the approach of how I approach looking for particular, investments. And there's some things that I've noticed over time that I think would benefit investors to know. Probably yourself, retail investors and whatnot. So I'm going to go over some things and how I evaluate if something's worth the squeeze. Is the juice worth the squeeze, so to speak? And if you've got some really good opportunities for investment and you're at the bottom, I'm going to kind of show you here how I view some of these investments of which ones might be the biggest potential for movement. And these aren't going to be 100% right. Nothing's 100% right, it seems like, in the investment game. It's all based off of statistics and probabilities. So we're just trying our best to capture some of those massive gains that could potentially be out there. And I'm going to show you kind of what I look at. It deals more with a fractal type approach, but it's nothing really mathematic based. It's just basic kind of numbers. Now, what I have for like an investment, if you're looking for investments and you want to say, where should I be investing? It's based off the real estate cycle. That's what I found to be the most reliable indicator, is where you are in the real estate cycle. And I'm going to go into that here really quick, just to touch on it. This is the housing starts. What housing starts are is just new homes being built. And new homes being built and the quantity of new homes, it has an impact on investments because it has an impact on inflation and it has an impact on interest rates. And interest rates prices all assets in the world. It has an impact on net present value calculations. The higher the interest rate or the lower the interest rate, effectively giving the valuation, the PE ratio valuations to stocks. It also prices bonds. It prices absolutely everything. So more or less the demographic of the United States and the relationship between the real estate sector and that demographic is determining the pricing of all assets in the world through the reserve currency. That's what I have found. And you want to look for alignment for your investments. And you want a turning point either from an expansion phase lower to a recovery phase, or recovery phase to an expansion phase. They favor certain investments during these types of periods. And sometimes it's difficult to figure out exactly where to be if things are whipping around back and forth. But the ultimate alignment that you want to see is a cheap commodity to stock ratio at the beginning of an expansion phase for commodities. And that's exactly what we have aligned at this moment. So this is the new housing starts. Whenever you go into an expansion phase, which is the green area under the curves here, those are good areas for investment in commodities, especially if you have a cheap, and that's what these circles are, cheap commodity to stock ratio, which means that commodities are cheap. The money's not there. And that's what we have coming up. So we want to look at commodities. And one other thing I want to touch on here is this is the commodity to stock ratio. This is when it's cheap in relation for commodities. This is when it's expensive in relationship to stocks. So commodity buy points are down here. Commodity sell points are up here. And this correlates very well with the real estate cycle. It's not perfect, but it correlates incredibly well. And we are in an expansion phase of real estate with a cheap commodity to stock ratio, which is the thesis of the channel. So the next thing I look at, and I'll kind of just come back in here real quick and say something. So we know that the commodity sectors are the spots we want to look at. In an inflationary expansionary phase, the spots that usually do well are finance, like banking type stuff, because they're going to be making loans at higher interest rates. They're going to make more money. Real estate usually does very well in this because you have a housing shortage creating the expansionary phase. So real estate's going to go up. Commodities do very well because you're in an inflationary environment, and usually interest rates go up in this inflationary environment. So you have a real negative yield that's putting pressure on bonds to be sold and pressure on stocks to be sold. And the reason there's pressure on stocks is because your interest rate's going up and your discounting net present value calculation is changing for lower valuations as interest rates go up. So when you discount that growth back to today, the valuation is lower using a higher interest rate. So you're going to see PE ratios contract as interest rates go up. So money will basically leave bonds and stocks and seek something that is more inflation sensitive or a hedge against inflation. That is your, what I quote, the rotation of money. Now, ratios just tell us where money has flowed or has flown from, and how it is flowing between each other would be a increasing or decreasing ratio. So that's telling us what exactly is happening. And what I have here, and I've shown this before on the channel maybe once or twice, this is your leverage to the price move. So it's how far out of whack did the ratio get, and if the inflation comes in, depending on how much the inflation is, this is kind of what your projection would be if the ratio were to revert to an expensive state at the end of an expansion phase of real estate. So these are the potential leverage to the investment. And so when I go in here, I did one for a platinum price projection. The multiple, this is the price of platinum. This is your ratio compression or expansion. We compress down to 0.5 to gold, and these are your gold prices. So your sensitivity as gold price goes up gets amplified as the ratio expands. And 3 is kind of like, I don't know if we'll hit a 3, but maybe a 2, 2.5 is a high likelihood. And if gold were to go to $10,000 an ounce, which is basically, it's just counting for all the money that's been in the system, and it could very well go to 15,000, it could go to 20,000. It all depends on the psychological scare that people get when they start swapping money over, and how fast it goes up because people are going to be chasing from FOMO. But if it were to go up to a large number and it compresses to 2, like say 10,000, that's a $20,000 platinum price. So that's a lot of leverage because we're only at 1,000 at the moment. So it's a 20x from where we are today. And that's if we were to get to a price that expensive. Maybe it's only $5,000 and we get to like 10 grand. I don't have that answer, guys, and no one does. No one's going to have that answer. But what this is doing is it's telling you the sensitivity. That's the important part that I want you to get. It's telling you how sensitive these investments can be given certain market conditions. So platinum is leveraged to gold in an inflationary environment, and I think this ratio will compress over time. The ratio compressing is your supply demand. Your gold price is your inflation indexed movement up and down. So when I say this, inflation moves the ratios up and down in its entirety because you're indexed to gold, and gold's your inflation hedge. Your ratio of it moving this way against gold is your supply demand characteristics that are driving that. And usually when you have a inflationary environment, your gold price goes up and your ratio compresses. So you have this multiple effect on the price movement because you have the dollar going down, gold going up, and you're compressing against a moving target that's moving up, which would be gold. So we're looking at all this. So platinum is a good potential investment because it's a leveraged move to the price of gold, especially in the beginning of a bull market. That's just history, knowing a little bit of history. Uranium is a super leveraged bet because if you can buy it when it was under 60 to 1, 60 pounds uranium to 1 ounce gold, and it compresses below 10, you can see a huge hockey stick effect where it really ramps higher at an exponential pace. So there's a lot of leverage in the price of uranium in relationship to gold if the ratios were to compress based off of history. And history, usually you see a cheap ratio of like the 40 down to like 5. We got below 60. It was 62, 63 when I was talking about on it on the channel, which is off the charts here. And we could compress and overcorrect to 1-to-3 ratio, which means that this would be a massive compression move and value creation. Because if you look at platinum, this is a linear relationship. Uranium is not linear. It's an exponential type movement as you compress below 10. It really starts to go. It's below 20, it starts to move quite well. Below 10, it really takes off. So what this is telling me is that if you were to look at previous bull markets where I gathered some of this information, the ratio compression is always going to be the same. But in previous bull markets, we've seen it compress to 5 or below, and we've seen it start from 40. But this time we're starting below 60. So I should say above 60. It's over 60 pounds to 1 ounce gold. And usually when you're that cheap, it'll over compress to the other side. The fundamentals of uranium are also better from a market balance, like market balance deficit surplus. We're going to see larger deficits in uranium going forward than we've ever seen in history. So uranium has a lot of leverage to the price move of inflation, and we've got the best fundamental backdrop that I've ever seen of any investment. And we've started from the lowest valuation starting point. So the conditions that were set up before this screwed up the commodity complex. All the money flowed into other assets, creating the stock to commodity ratio to go to extremes. If we can buy at the extremes of this bottom of the commodity bull market, and we know the leverage that we have in these moves are the greatest in, say, uranium, and we've got some other ones I'm going to show you too, and platinum's very good from a low risk standpoint. These are two very good investments that you want to look at because of the leverage to the move that's potentially coming. Now, I've got a couple other ones here that are also, I would say, very ridiculous. So I've got the oil projections here, and oil is also leveraged quite dramatically. I started this at 50. The actual ratio got below, I got above 100. It got to ridiculous levels that you can't even imagine. So it went so far to the downside. And what you're going to notice is when I talk about this stuff, when valuations go like skewed to the downside dramatically, they're probably going to skew to the upside dramatically at some point, because the underinvestment and the pullback on the investments will be so large because the commodity was so cheap that everyone had to cut back so much just to survive. But it's hard to reverse that and start to grow quite rapidly if that commodity goes into shortages. So oil was in this scenario, same as uranium. And this is a highly leveraged bet when this compresses. And remember, this is your ratio on the bottom, the price on the left-hand side, and this is your gold price at the time the ratio compresses. It doesn't mean that the peak gold price will necessarily be, this is supposed to be 15,000 here, but it doesn't mean that the peak gold price is where the compression maximizes out at. You know, it may go all the way down to we'll call it the minimum ratio of about 5 or 6 or 7 or 8 at the time that gold is 5,000, even though the ultimate gold price may reach 10 or 15,000. So you have to use what it compresses against, and oil and uranium usually compress a little bit earlier in its cycle of the gold price movement. So we might compress down to 8 or so, and if it's down here, we might get a price of, you know, $1,200 of oil if you had a very large gold price. If the gold price is 2,000, you might only hit 200 or 220. It highly depends on the gold price and how much inflation's in the system and when oil peaks against gold. But either way, this compression is quite dramatic as you get below a 10 to 1 ratio, and even a 20 to 1, it starts to really move. So there's a lot of value in uranium because of its compression of the ratio against assets. And what this is telling us, it's telling us that the most potential is in these. It's in energy. And the way that this is compressing and compressing its ratio gives us the most value at a blow-off top, is what it's telling us. And history has shown that for us. And natural gas price projections probably have the most blow-off potential. And we've seen that in Europe and China. And remember, I created these calculations far before any of this happened. So this is natural gas price projections. This is the ratio compression. And you can see it really starts to go vertical after 10 to 5 and up. So you could see ridiculous prices of natural gas if natural gas were to go to a shortage and we had a high gold price with inflation in the money system. And we've seen that in Europe, we've seen it in China, we've seen it in all these areas. So it's not like I'm making this stuff up. We've seen these go vertical. So in my opinion, in the commodity sector, these were the ones that I focused on the most because they had the most leverage to the price move. They also had the most downside that I've seen. So whenever you compress the ratio the most, you go from the most undervalued scenario to the most overvalued scenario. That's the usual likelihood, is when you go far right, you have to go and it'll react to a more overvalued state eventually. These have the largest compressions, and they also had the largest compressions in other previous bull markets. So uranium, platinum, where the ratio is, silver is also very good because they're both leveraged to gold. And natural gas and oil are all very good bets. In my opinion, usually what happens is you see the energy sector start to take off in the beginning of a bull market. Gold takes off, and then it rests for a while, and then these guys go crazy. It infiltrates in all of our measurements, like the CPI, PPI, all that stuff goes up, and then gold and silver hit it on the back end. Platinum, it's kind of mixed. It acts as a commodity, almost like copper does, in the beginning of a market, and usually platinum outperforms gold in the beginning of a commodity bull market. That's why the platinum to gold ratio is one of the indicators that people use, signaling that the economy is recovering or that a different environment is coming. So they use copper to gold ratio and also the platinum to gold ratio. Platinum and copper also have very favorable market balances. They're going to have deficits out in the future. And you could say this about a whole bunch of different commodities. And that's why a commodity super cycle is most likely coming, in my opinion, because of the market deficits and because of the inflation aspect. Both of those things linked together will bring the ratios higher and compress them further against each other. So that is how I identify where the value is and where the most potential reward for the investments are based off of these calculations that I did in Excel. So then what I do when I look at companies, the companies that I look at are in TradingView, and this is where, one second, guys. So this is where I look at for the companies here. And what I look at is this company here has a large compression, like it's got a large move lower. And I'm looking at this, it was up at $700 or something like that, and we saw a massive sell-off. Down here was 90+% sold off, and it was absolutely decimated in the commodity bear market. And this is where the greatest opportunities are, so long that they don't go bankrupt. Intrepid Potash was one that went absolutely berserk to the downside, and it's coming back up, and we broke its downtrend line. This would be the ultimate buying opportunity because we could see in the ratio of the commodity to stock ratio and the changing market conditions for real estate that was going to turn this thing and turn it around. Now, I'm obviously telling you this looking hindsight backwards. And I did buy at $9 for Intrepid Potash. And I basically relied on the ratios and the market condition change for this to eventually change into more favorable conditions. And I bought it in the October timeframe when I was buying a lot of this stuff. It was like around $9. That is how I did it. And the reason I chose Intrepid Potash was because of the way this thing declined. It went to very low levels. We also had increasing volume at the bottom. We also were at a double bottoming position where I think it was going to double bottom, and I just threw some in. I didn't throw a huge amount. That was probably my downside, but I did throw a little bit in there, and I threw more in when it broke out up here. So Intrepid Potash was one that I looked at because if you were to look at this reverse, you had the most upside potential. And fertilizer companies also do very well in which I would think was a oil problem world. I just figured fertilizer and food would be somewhere that they're going to have to look at. Looking at oil, because I know that this one is a highly leveraged one, I chose SM Energy as my top pick because of the valuation. It was all the way up at about $95 in 2013, and it went all the way to $1.50 when I bought a lot of it. The reason I chose this is if I were to zoom in here, the bounce from the bottom of $1 all the way up to about $7 was a very large bounce. And if this was a first wave move in Elliott wave, and Elliott wave means you have a first wave, a third wave, and then a fifth wave. And then you go into a consolidation period for a little bit. And the consolidation period is going to go sideways. This first wave, if it's a really big one, most likely will result in a massive third wave and fifth wave. And that's what I used to gauge which ones to go in. Was I gauged the bottom to the top of the first wave, and then the pullback in between the first and third wave. So that's how I gauged it. Now, we could have a correction here. We could go sideways for a little bit. I'm not too worried about that because the market that's coming is going to be massive. And this first, third, and fifth wave is probably the first wave of a massive wave. We might see a little bit of pressure going sideways or whatever, and then we're going to see a big move. A big, big move, in my opinion. But this first move up is what I was looking at. Another one that would have been a great one, because we're going into an expansionary phase of real estate, was, and I can't pronounce the name of this, guys, HOVN, however you say it. HOV is the ticker symbol. And the reason, I missed this one. This was the one that got away that I'm still mad at myself about. It had the descending wedge pattern, and I just wasn't looking at this company at that time. I was looking at it, but I wasn't looking at it from the chart perspective. One thing that I had wrong here, guys, and I'll admit it, is I was focusing more on work. I was focusing more on family stuff, and there's nothing wrong with focusing on the family, but on work type related stuff. And I shouldn't have been focusing on work. I should have been focusing more on this. I could have made far more money doing this stuff than focusing on work. Work is not going to pay me enough money for the returns I could hit here. And I should have been focused more on this, and I'm focused more on it now, definitely. But I should have been more focused on it before. But this is one that I missed out on. And I only put a little bit of money in. I should have put in a whole bunch. But HOVN, I saw it down here at $6 and something cents at the bottom of March of 2020. I knew that we were going into an expansion phase of real estate, but I wasn't really looking at the housing, the home builders. And the reason I wasn't is because they already had taken off on some of them. And this one was way down there. And I just, for some reason, it wasn't clicking as much as everything is now. And HOVN, I remember seeing it at $6. I'm like, wow, that's really cheap. And then I looked at it again, and now we're at $112. And this thing has a massive upside potential for this descending wedge that could go far higher than where it is today, because we're at the beginning of a expansionary phase of real estate. So this was one that I missed out on, but this one also has big potential, and it was down from 1,754, probably some dilution or whatever it is, all the way down to $6. So it was down many, 90+% from its highs, 99% plus. So that was another one. So we have SM Energy. Now uranium, since that's a very high one too, I chose Bannerman. And the reason I chose Bannerman was a couple fold. And I did buy this one at its lows. It was in a downtrend. It was going sideways. And then I bought it in here of the September 2020 timeframe, October. And then we got the launch. The reason I chose Bannerman is because they were the cheapest on a reserve per pound basis. I knew that uranium was a very highly leveraged sector. I knew that the ratio was below 60 to 1. It was 63 pounds to 1, I think, was the ratio at that time. And it was in the accumulation phase, about to break out, and it was coiling up. So when I was looking at this, I was looking at it and I said, well, this is probably the best opportunity stock to buy because of this chart behind here that was basically pinching up into a corner, and I could buy it in October 2020 for 2.5 cents. And I was looking at it, and I spoke with Terry, and I said, hey, is there anything wrong with Bannerman? Because why is it so cheap? Why is it 19 cents a pound? And he said, no, they've got a good CEO. Everything's good. And I was like, all right, I'm in. So I made a good decision there. And it's paid out, and I'm continuing to hold on. I'm not selling anything. The ratios are still incredibly cheap, and that's what I use for my exit strategy, are ratios and market conditions, which is the housing market. So the way that I chose this one, and it seemed like it was a contrarian play within the contrarian. So everyone was saying Bannerman they can't raise the money. They can't do this. They can't do that. That's all I heard. Nobody liked Bannerman at the time of October 2020. And I was like, well, that seems good to me because I like it when no one else likes it. And I added into Bannerman, Encore Energy, Deep Yellow, Baseload, Next Gen Energy, Fission, Uranium. I added in at that time into all those companies. And Deep Yellow was in a similar situation. I had a chance to buy it. I was kind of just doing my research. I saw it. It was at like 18 cents or something like that. It was like right in here or somewhere. Yep. It was right when I started researching it. So I started researching probably in May or sometime in the summer. I can't remember. And that's where it took off. Same with the Next Gen. It was down here somewhere. It was right here then, in this big pattern. And the way that I'm looking at this is I was using fractals and how big these movements were up and down and how volatile the stock was. And I was using the compression on the ratio to identify what sectors. So I overweighted the energy sector based off of the leverage to the move that could potentially be coming. So I overweighted a lot of oil, natural gas companies. I overweighted uranium companies. I still held on to some precious metals companies. And I like my physical metals because that's the lowest risk way with no counterparty risk of any sort to play this big move that's coming up in commodities. So that's how I chose it. It was basically, how were these things falling and how much did they fall? If I could go back and do it again, I would have obviously put a lot more money in HOVN, in Intrepid Potash, I put a lot in SM Energy. I put a lot in Bannerman and the ones that I would have done. And I nailed a lot. I nailed the energy sector down quite well. The ones outside of the energy sector, I didn't nail down as well. I didn't have that. I don't have a fertilizer ratio to really say I want to lean into this. And same with the home builders. I didn't know as much about the home builders and the companies themselves. So I didn't lean in as much. I didn't overweight that. But 2020 looking backwards, like looking backwards with eyesight of 2020 is always easy to look back on. So the way that I choose companies is that process. I use the real estate cycle to focus in on where I want to look. I use ratios to identify value. I looked at ratios to identify what the most compression had in history. Energy had the most compression, and then some of the other ones were also good. I still like copper, silver, platinum. Those are also very good for compression, which means it's good leverage to the move of commodities. So those are where I was focusing on the most. And the way that I looked at the companies was I was looking to see how their bounce, how far were they off their highs? Are they at their lows? Were they making good chart patterns? Do we have a downward, sideways with a squeezing up, and then an upward move? And then later on, I learned a little bit more about some of these other sectors that people have brought up on the channel. Rare earth metals probably present a pretty good opportunity. Never was a big lithium person, but lithium killed it. They've done incredibly well. I got lucky by buying Plateau Energy, which was bought out by American Lithium, LIACF, I think. Plus, we got warrants on that, so that's good. So there's a couple things I lucked out on, but that would have also been other good opportunities if I had known about it. I'm sure there's other opportunities like graphite and other things that would also be worth looking into. But I wanted to create this clip, let you guys know kind of how I choose some of these companies. That's basically what I do. And you can go in and look at the fundamentals of the companies on their websites as well. I always go on their websites and I kind of look to see what their cash flows are, what type of, are they going to go bankrupt, basically. I do research on what other people think about it as well in terms of their risk of going bankrupt. And if there's a low risk, then I might take that bet and just pile into it. And then I diversify out and I keep my position sizing below 5% for the majority of it, of the entire portfolio. So I never take a single position much larger than 5%. I might push it to 6, 7, 8, something like that, which I did on SM Energy. But I don't really exceed too much past that because you're just banking all your money on a single company and something can go wrong where you get wiped out. So that's my approach, guys. Hopefully this helps you on looking for stocks yourself. I am still holding on to all these. I don't have any reason to sell. They're of great value. The ratios are still good, and the market conditions are good. So I think they're going to still go up. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.